So Joanne, I've been so excited to have you in front of my clients, just with the craziness that's going on in the market, certainly all the politics that's going on as well, and how you guys are maneuvering through all that. So I'm just really excited to.
Yeah, well, happy to be here. Thanks again.
Yeah, I haven't talked with you individually for a while. So it'll be, I think, really fun to hear your point of view. So
Well, I
perfect,
got
perfect.
some good slides here for you, and I'm also happy to answer any questions. And I do have the chat box open also, so if anybody wants to type questions, I can try to field those as we go. So I'll keep this chat box open here.
Perfect. Okay, good. Well, with everybody's time being short these days, I'm going to start the meeting. So for all of you, I know many of you on the attendees list here, I can see have heard Dr. Feeney before, but I'm thrilled to have her again. So let me introduce her. Dr. Joanne Feeney is a portfolio manager and a member of the investment committee with Advisors Capital Management, one of my preferred money managers, as you all know. Prior to joining Advisors Capital, Dr. Feeney was a senior equity analyst for more than 10 years at boutique sell-side firms. She focused on the valuation of semiconductor companies. Dr. Feeney also consulted for the Federal Reserve, the International Monetary Fund, and the World Bank. So she's a very learned lady. Dr. Feeney has appeared often on Bloomberg, CNBC, and is frequently quoted by Barron's and the Wall Street Journal. And I just saw her the other day. I was walking by my TV and there was Joanne on a major network being interviewed. And I went, hey, I know her. So thrilled to have you on today. It's going to be great to get your point of view from the markets. So we very much appreciate it, Joanne. So with that, I'll let you take it away.
Okay, let me just share my screen here. And let's see. You've got to enable me, Kelley.
All right, let's see. Where do I do that? Let me find you. Okay, panelists, there you are. So I gotta go here and I've gotta go. So do I make you co-host? It doesn't say, it doesn't
That
say.
that would do it. You could do that.
Okay, let's make you co-host. There we go.
Okay, let's see. There we go. Okay, can you see that?
Yes, absolutely.
Awesome. Okay, so yeah, what I did was put together some slides with sort of where we are, where we've been, where we might be going, and some of the investment committee views on the outlook for equities and for bonds. I'm coming to you from northern New Jersey. Advisors Capital Management is located in Ridgewood, which is just outside of New York City. I'm working in my home office today, or tonight. It's 9 o'clock out here.
Oh boy.
Normally, pre-COVID, I would be with you all, and you would all be doing this in person, and Kelley would be putting on a wonderful event and lots of wine and food. So I miss that part of it, Kelley.
Yeah, I bet you do.
Maybe one of these years we'll get back to that.
Yeah, maybe.
Okay, so first of all, I'd like to start out these things with sort of just a quick look at the market. So the blue line is the S&P 500 since mid 2018. The red line is the volatility index, the VIX. And it's actually come down a little bit since I made these slides about a week ago. But as you can see, volatility is still higher than where we were in, say, 2019, pre-pandemic. It shot up, obviously, with the pandemic. Volatility index is a good measure of how investors are perceiving risk. It's sometimes referred to as the fear index. And so when it's elevated like it is, it means that investors are recognizing that uncertainty is a little bit higher than normal. But nevertheless, the S&P 500 has climbed quite steadily, not without some bumps in the road, but has climbed certainly since the depths of the pandemic drawdown. And there's good reason to think it should continue to climb, particularly over the investment horizon that I'm sure Kelley has advised you to focus on, which is not a quarter or even a year, but multiple years into your full horizon, your planning horizon that's driving your desire to invest in the first place, which is probably many years. So one of the things I want to point out, though, is that not all stocks have behaved the same. And this is from the beginning of 2020, this chart. And so again, the SPY is an ETF that tracks the S&P 500. So that's bounced back the most. DLN is an ETF which tracks the Wisdom Tree Large Cap Dividend Index. And the SPY-D is an ETF that tracks the S&P 500 higher dividend stocks. So what you can see from this is that income-oriented investors in the equity market are still lagging. Those stocks simply have not recovered much. And in particular, as you can see from the SPY-D, they've really sort of flattened out since the spring. And there's some good reasons for that. Probably most notably is the spike in and the appearance of the Delta variant. So that actually appeared in about March over in India. And then it spread over to the United Kingdom, and then it spread here. And that really created some doubts among investors in the pace of economic recovery and how much that might slow down because of this Delta variant. And we've certainly seen some of that, not just in the United States, but, and perhaps more importantly, in other parts of the world, because as you're aware, right, this is a global economy that we're all living in the middle of, and the supply chain really depends on manufacturing being up and running everywhere. And we had Malaysia shut down factories, we had China shut down factories and ports, and obviously we had slowdowns elsewhere. So some of those higher dividend stocks reflect more than just the average stock in the S&P, reflect the pace of economic recovery. And so if that looks like it's going to slow down, you'll tend to find that affecting some of the higher dividend stocks, because those companies tend to be the bigger conglomerates, tend to be more exposed to the overall pace of economic growth. But the S&P 500, as you can see, while it did dip down here in the summer and into the fall, has once again picked up its pace. And so guess what, guys? I can no longer see the chat column. And Kelley, maybe you can monitor that and jump in if somebody has a question.
Okay.
Okay, so let's just take a quick look at what's going on in the economy. And we have seen, despite the spike from Delta, we have actually seen reopening continue. And this chart shows you a number of ways that we measure that. So we're very data driven here at Advisors Capital. I'm an economist. Chuck Lieberman, one of the co-founders of the firm, is an economist. So one of the things we like to do is really look at the data and see for ourselves, what's going on in the underlying economy. And the reason we do that is because the stocks we want to own for you, right, are often going to be affected by that broader economic environment. And even if we don't choose to buy what some people might, call the hot reopening stocks, like an airline or a cruise line, these kinds of metrics, the willingness of consumers to go back out there and spend, will affect other stocks that are sort of less obvious reopening plays.
So let me interrupt you a little bit here, Joanne, if you don't mind. One of the reasons for all of you listening here that I love Joanne and I love Advisors Capital is because they buy individual stocks for your portfolio. They're not buying mutual funds. So they're getting rid of a lot of fees that happen to be involved with those, but it also makes them much more nimble with the market. So as she talks about what they're looking at to invest in here, I love that they can do that. They're looking at, okay, what's going to be the next best thing out there? How can we make money for all of you based on individual stock positions that we own? So I just wanted to bring that to the fore here because I forgot to say that in the beginning, but important difference that you guys have versus any other money managers out there, which is why I picked you guys to help my clients. So
yeah, thanks. Yeah, thanks, Kelley, for highlighting that. We typically own 40 to 50 equities in a portfolio. And then if it's a balanced account, for example, then on the fixed income side, we would own 12, 15, 20, depending on the total money that's invested. Because we don't want to own, never want to own too much of any one bond, for example. I'll talk a little bit more about the fixed income side later, but it's even more advantageous to be able to buy individual bonds and preferreds given the fixed income environment in which we're currently living, which is very low interest rates. So we're able to pick and choose out of many hundreds of bonds and prefers. We're picking 12 or 15, so that is an advantage. And so, yeah, when we do look for those individual stocks, we do want to look at this kind of data and see what it's going to do for theme parks, for example. We own Six Flags in the growth strategy, and that's done very well as the reopening has proceeded. And this is one of the sets of data that we look at to see how things are going. So first, I'll start with the good news. Okay, the expansion is continuing. You always have to be careful when watching the financial news channels because they like to really accentuate the negative because it's more dramatic. But the fact of the matter is, again, as an economist, I can tell you, economic growth is progressing despite what you see on the news about all the boats, right, sitting outside of your coast out there in California. Those ships sitting there laden with goods are actually a sign that growth is very strong, that consumers are spending, because it means that incomes are up, people are getting employed, they have money to spend, some of it because it was saved all of last year. So the underlying economy is pretty good. The Delta variant is waning, although here in the Northeast and in the middle of the country, we are now seeing a pickup in cases. And nationally, we are up from the low of, I think, somewhere around 64,000 cases. We're now over 80,000. And it's primarily, it seems, locations that didn't get struck by the Delta wave because of initially high vaccination rates. But there's still 60 million unvaccinated people in the country. And so that's a lot of fertile ground for this virus to spread. So even though we're in a high vaccination state in New Jersey, for example, we are now starting to see a pickup in cases. And so we're going to keep an eye on that because it could cause some problems. We're also seeing it in the middle of the country where some of the automotive factories are located. But with so many people vaccinated, there should be plenty of employees to be able to continue to work and keep those manufacturing lines running. So while it's a bit of a concern, the cases are rising again. As the medical experts are saying, if you're vaccinated, you can go out there, you can go to the movies, you can, go to your families for holidays, etc. So we don't think it's going to be such a big issue for the economic side of the US going forward. And also unemployment, right, continues to drop. Even though there are still a lot of people unemployed, the number of job openings is over 10 million. The number of legitimate unemployed is probably well below 10 million. And interest rates remain low, even as inflation surges higher than we've seen it in a while. And depending on how old you are, you might remember back to the late 70s, early 80s, when inflation was 12, 14%. Okay, we're not there. And unlike back then, when inflation was largely driven by a much more serious oil spike from the embargo by OPEC, we are not suffering an embargo right now. We have plenty of oil. We have all the oil and gas we want. This is a bit more expensive than it was a year ago. And that time also was a much different monetary policy environment. Since then, again, we have decades of research and knowledge and many more tools at the Fed's disposal that we're not so worried about, inflation getting out of control. And in fact, we understand, as probably many of you do, that the price increases we've seen, many of them are driven by the strong consumer demand in the face of a limited ability to increase supply, right? Those supply chain bottlenecks, semiconductor shortages, right? There are identifiable reasons why inflation has run up. That is why prices have risen. And as the more manufacturing comes online, as the supply chain gets, smoothed out and ungunked, right? We would expect many prices to come down. Obviously, if you're in the market for a car, you've gotten the message. Try to avoid buying one right now. Put it off for a year, right? So, Yeah, so we're in a pretty good economic environment. Interest rates are very low, which is a positive for firms because money is cheap. They can borrow to expand. Um, it's good for households that need to borrow. New house, send your kids to college, whatever it is. Obviously, it's not so great for people that are trying to save in the fixed income market. Again, we're able to do a bit better than the market by being really selective, but that's why a lot of people continue to invest in the equity market because you're definitely facing more risk, but you can lock in a dividend yield that's much better than what you're going to find on the fixed income side potentially. And the other thing that's positive about the current environment is that earnings growth is above average. And it's likely to stay that way for a while because we are still recovering from this shutdown. And companies are trying to serve this very strong consumer demand. And the thing about the shortages, whether it's semiconductors or lumber or the supply chain bottlenecks at the ports, is what that implies is that, well, we're not recovering as fast as we would if everybody could instantly go back to work, if factories could instantly ramp up to as much production as they wanted, and if there were no bottlenecks at the ports, we would certainly grow a lot faster in a hurry. But we can't, right? There's, sand in the gears. It takes time to hire people. And so what this means, though, is that earnings growth is likely to stay above normal for a longer period of time as everything catches up. So that means that companies then are likely to see, again, profits grow above normal for a longer period. And that's a pretty good time to invest because you're buying companies that are going to see abnormally high earnings growth for several more quarters, in addition to some of the normal secular growth drivers that make owning company stocks really attractive. Now, people have remarked about the valuation of the market and is it too expensive? We'll talk a little bit more of that with some slides later, but let me just assure you that there are plenty of attractive valuations out there, including in the tech space. Companies have a lot of cash on their balance sheets, so they're able to do buybacks of stock, which raises the price of stock down the line. And they're also able to pay higher and higher dividends. So it's a pretty good environment for the equity investor. But there's also risks. Certainly the shortages and supply chain bottlenecks are constraining companies, right? Some of them are saying in their guidance to this quarter, well, we could be producing more and we would have higher earnings, except we can't get all the parts we need. We can't get the stuff, through the ports. And so it is constraining profits relative, to what they could be without these shortages. So that's a negative. But again, it points to a longer period of recovery, which is ultimately a positive. Also, these inflation concerns, while we can point to many things that are transitory coming from those shortages, there is a broader concern about wages. Wages are rising. We've all seen the help wanted signs, and we are seeing wages going up. And that's sort of a double-edged sword. On the one hand, consumers are going to have more money in their pockets. That's a good thing. It means they can go out and spend. On the other hand, that the companies are facing higher labor costs and they're going to try to pass that on into higher prices. And so far they've been doing that. So good for them, good for their earnings numbers, not so good for consumers. But we have to be a little careful about circular logic. People are worried about inflation going up and won't that constrain consumer spending, right? But that's a circular logic, right? Why are prices going up? Why is there inflation? Because there's a shortage, because there's so much consumer demand. So all that consumer demand is what's driving inflation in the first place. And so then you don't circle back and say, okay, so high inflation means lower consumer demand and we're worse off. No. If consumer demand goes away, so does inflation, right? So the reason for the inflation is a strong consumer demand. That's a signal of how strong consumer spending is. And that's actually a positive thing. The wages is another issue. So far, firms have protected their profits, but ultimately we would expect profit margins to shrink. Again, you get a little bigger, you're still making more profits overall, but your margin is a little smaller than it used to be. Still a good place to own companies. The other things, though, are more nebulous, right? We do have another debt ceiling that Congress has to sort out. The US government, right, they make policy and they determine fiscal spending and they set tax rates. and we've been running a deficit for a while. And so the total debt for the government actually legislatively has to be raised every year. If we're running a deficit every year, we cap the amount that we can carry as debt. So the debt ceiling has to be raised in order to allow the government to keep functioning when it's running a deficit, as we are currently. The debt ceiling will most likely be raised. It expires, I think, on December 3rd. It has to happen, but there'll be lots of political noise between now and then. But nevertheless, it's extremely unlikely, even with the brinksmanship, that will happen. Certainly between now and then, that the debt ceilings will be raised. So while it could cause some volatility in the equity markets if people start to worry that it's not going to get done on time, ultimately, again, for our investing horizon, it's not relevant. It'll get fixed. And then the other political noise around the other big fiscal policy. So today, the infrastructure package was signed into law. That's a 5-year program to spend more money on fixing bridges and highways and rails, water, broadband to rural communities. I think electric vehicle charging stations are in there and all sorts of stuff. So that's a positive overall, because number one, it's spread out over time. So it's not going to suddenly, increase demand in a way that would increase inflation. And the ways that it's being paid for are all very modest and are unlikely to disturb the potential of companies to continue to deliver earnings growth in a way that would disturb stock valuations. So that's that's a really simple positive for long-term investors, because infrastructure investments tend to be productive. They tend to lower costs for the private sector. It's good if airports work and trains run and bridges don't fall down. And so that tends to be a positive long-term productivity gain for an economy. So overall, a positive that the infrastructure bill got passed, but the uncertainty now is the other one, what's called the Build Back Better plan, which is more like human infrastructure, right? And what do I mean by that? Well, if it makes people more productive, or it makes people more willing to work, then that can also be a positive. So for example, pre-K education gets kids started earlier in learning, right? And they could become more productive adults, right? Better for the workforce. Or the effort to do things to, help women get back to the workforce, for example. Whether there's childcare or child payments in there, could allow more women to get back. And that's been a big problem for the economy. All the women that left the workforce during the pandemic because they had to take care of kids or elderly relatives has really detracted from the working age workforce, the people willing to actually go look for jobs. So there are some positives in that plan as well, but there's a lot of details we don't know about. We don't know what the tax structure would be like if such a bill passed. We don't know where the tax burden is going to lie. So there's a lot of uncertainty around that, and that could cause some equity volatility as well. China.
I'll ask you a brief question here, because I know my crowd here and they're going to want to know, is there too much debt? Is there ever a point that there's too much debt? I know the debt ceiling needs to be raised if we're in a deficit and all of that. With all these extra spending bills that we're looking at here, is there ever a point where it's just too much debt that they're passing, or?
Yeah, there could be a point where we are nowhere near that right now. The amount of debt that the U.S. economy is carrying is minuscule in relation to the U.S. economy's size and its ability to grow. So, for example, right now we have GDP growth of 4 or 5%. Okay, the interest rate, right, the U.S. Treasury interest rate on a 10-year bond is 1.6%. Right, so we are growing faster than the cost of carrying the debt. And that means that the government doesn't even have to borrow more money to service the debt, right? The growth of the economy creates more tax revenues, and that automatically pays for any extra interest on the debt. So when growth is higher than interest rates, when GDP growth is above the rate of interest, then there's, basically there's never a time when you can't add more deficits.
Do you see it all with interest rates on the rise, which we're seeing lately, that opposite could happen? That we could
Yeah.
have that than what the growth is?
Yeah. In most of history, it's been the case that growth has been above the interest rate at which the federal government borrows. But you're right, it could and it has flipped around at certain times. But when we're an economy that's growing even 2%, that's in real terms, right? These interest rates are nominal interest rates, right? So even in the sort of the normal long run US growth, it's like 2% real GDP growth. You add inflation of 2 or 3 or 4%, means you have nominal GDP growth of 4 or 5 or 6%. It's very rare for the federal government's interest rate to be anywhere close to that. So we can actually carry quite a lot of debt because our growth is generally, above the interest cost of the services on the debt. And so, if it gets really big, right, then the interest payment could be so large that you wouldn't want to carry that much because it is a drain, right? You can't do other things if the federal government has to use a lot of money to service the debt, right? So let me be clear about that. Right now, at the debt to GDP ratio that we have, it's not such a big burden on the federal budget to make those interest payments. But what we like about what's being discussed, at least for the infrastructure package, is it's productive spending, right? It's spending that increases productivity for the private sector, and that's a positive. So whatever this Build Back Better thing looks like, that one will take more parsing, right? If it's productive, that's sustainable, that kind of spending. If it's purely transfer payments, then that comes down to an equity discussion. Do we as a population think that's a good thing for our federal government to do? But the bigger question you're asking is, does it inhibit economic growth if the debt is too large? And at the levels we're currently at, debt to GDP ratio of around 1 or 90%, it's a very, very small burden for the federal government to sustain, particularly when growth is running so far ahead of the interest cost. So plenty of room. Other international issues, right? China, we still are fighting to get China to really level the playing field, right? They are notorious thieves of intellectual property, right? Every administration has been trying to curtail that. The last administration tried a number of different approaches to really curtail that activity, and really without success. It's almost up to the private sector to protect themselves better, and they find themselves in situations where that's really challenging to do. So what we're looking for is to see any thawing of relations with China in a way that would reduce the need for the administration to continue to impose these tariffs, because tariffs are raising prices for US consumers, and that's never good, and for US firms. And that's never good for profits and earnings, and ultimately for economic growth. So, we could look to see some thawing there. I know there's a summit right now, I think, or tonight at some point, between Biden and Xi. Not expecting much to happen there, apparently, but communication is probably a good thing. And we just don't know what's going to happen on the economic front. On the political front, lots of concerns about China continuing its flyovers of Taiwan and other activities in this South China Sea. We think the incentives are there for China to refrain from doing anything military. And I've noticed that the administration and its speakers have been trying really to discourage China by basically saying, don't go there because, we are committed to Taiwan. So, but, always have to worry about these military geopolitical risks, whether they're from China or from the Middle East or from various parts of Eastern Europe, et cetera. So one never knows what can really disturb the stock market, but that's why we design portfolios with stocks in them that we think provide some insurance against those sorts of shocks. But I noticed somebody had their hand up. Kelley, did you want to?
Well, so I have a question from a listener. Does it make sense to buy California state bonds and municipal bonds with California having surpluses for at least 4 years, and the last surpluses was allegedly $75 billion? Also, many cities have been bailed out by the federal government, especially Los Angeles.
Yeah, it only makes sense if the terms of the bond are attractive. There was certainly that incident some time ago with Orange County. So California running a surplus suggests that the risk of owning a California state bond is very, very low. I haven't looked at any of those issues. I am, and we don't own them. And I think the reason is because they're just not very attractive. So yes, they're low risk, but the coupon relative to the price of those bonds is probably not at all appealing. And they're also probably very long-term bonds. And that means that you're facing a lot of what's called duration risk, so that when interest rates do rise, the price of those bonds is going to fall a lot. A short-term bond, maybe 2 years, will have a very small price drop, but a 30-year bond could lose 10, 15% of its value if interest rates go up 1 or 2%.
Right.
So that's the risk you face in bonds.
Yeah, I know you agree with me on this, because I talk about this all the time to my clients, is I'm not having anybody in bond portfolios or bond mutual funds or anything like that, because as interest rates rise, bond values go down, as you say. And the longer term bonds that you have, the more that's going to happen. But where do you go for yield, right? So if you go longer term to get that higher yield, but it's not a very high yield because interest rates are low. So I look to other things, and my clients know this too. I've created the mass proprietary process. M is the market, A is alternatives, where I go for bond replacement these days, and S is safe money, when you don't want to take any risk with your portfolio. So we go to other places than bonds these days.
Yeah.
In my view, I think that makes more sense, especially over the next 5-7 years or so. Maybe you feel differently, Joanne, but I think it's important to make sure we're not losing value in our portfolios through interest rate environments that we see ahead of us.
Yeah, that's exactly right. I mean, what we've done is we've kept duration short. So for example, if you've got clients in a balanced strategy on the fixed income side, right, our duration will be 4.5 years. And what we do is we always calculate the total return, right? So we anticipate that the bond's price will fall over time, and we balance that against the coupon that's being paid. So we're getting 2.5, 3% expected return, even mixing in the expected decline in the price of the bond. So it's not much, but if you do want some money that's liquid and relatively safe, right, you're still getting yield that's double what the average corporate bond will offer, right? And we're doing that with just investment grade. We have also some higher yield bonds in like a T4 balance or a T5 balance, for example, and we can get 3.5-ish, 3.75% yield there. Again, combining the anticipated decline of the price of the bond with the coupon. So, but you have to be super selective, and that's why we have a dedicated team that does that, right? I don't do that, but we have a guy and two guys that are focused exclusively on this, and they're pouring through the credit analysis of companies. Can we own their bond? It's high yield. Okay, so that's why we're picking 12 to 15 bonds. So it's tough. It's tough out there. And then the last question is, are valuations too high? A lot of people are nervous, right, about the stock market is trading at about 21 times. So let's talk about some of these negatives, some of these risks. So the first one is supply chain, right? What's the cause of the disruption? One thing is, we've already talked a little bit about this. One thing I just want to make clear is that production is up, right? The shortages aren't because production has fallen. The shortages are despite the fact that production has risen around the world. And it's simply because consumer demand is so much higher than that increase in production. So the cause of the disruption is COVID, which is why, COVID is still one of the biggest risks to watch. Maybe not so much here in the US, but certainly around the world, particularly in Asia, India, and now some places in Europe. The Netherlands just instituted another partial lockdown. Austria just instituted a lockdown for their unvaccinated citizens. So it's the supply chain disruption is coming from COVID. So we have to keep watching that. We don't know how long it will last. It really depends on how quickly we can get COVID under control and whether there's a new variant that causes more problems. But we're certainly making progress, all right, around the world. And we're seeing it in automobile production. We're seeing it in the food chain because of various shutdowns. So far we haven't seen much of a profit margin impact, but we have to watch out for that. If people don't come back, and one of the reasons people aren't coming back to the workforce in the U.S. is ongoing fear of COVID. Some people don't feel comfortable going back to the workplace, and that's something that could change over time. Also, a lot of folks chose to retire early. Maybe there's some of you out there, right? You sort of said, hey, it's a pandemic. I'm close to retirement. I'm done, right? I don't want to go out there. And so a lot of baby boomers have decided, you know what? I'm going to leave the workforce, like 4 or 5 million of them. And that's a big chunk of people. And then you add to that the women that have left the workforce, mostly women, for childcare and elder care purposes. This is a big problem, and that's slowing down the ability of the U.S. economy to pick up the pace of production. The other thing that we saw is a massive shift because of COVID away from services, restaurants, travel, etc. And instead, people want to do something. They want to treat themselves somehow, and so they're buying more stuff. And so that increase in demand used to go to both services, restaurants, travel, etc. And now it's all going to goods. And so again, that's exacerbating the supply chain problems. So things will ease over time. So people will get more comfortable. People will go back to travel, back to restaurants. We saw that on one of the previous charts. But in the meantime, there's just a lot of mismatch out there between what we're able to produce and what people want to buy. But it will get better. Okay, as I said, the Delta variant has peaked. Unfortunately, since this graph was printed, this has started to go back up again. Okay, talked a little bit about inflation. Just one thing to point out, and I'm sure Kelley has made this point clear. If you take $50,000 in cash and inflation is 2%, 3%, or 4%, and you sit on cash, right? The value of that cash in real terms, in terms of goods and services it can buy, will go down over time. After just 5 years, that $50,000 is only worth $40,000 worth of stuff. If inflation is 4% for that 5-year period, it's worth $45,000 of stuff if inflation is only 2%. We can count on 2% inflation, right? Your purchasing power is going to fall over time. And over 10 years, again, you lose 20% of your purchasing power if inflation is only 2% a year, right? So, you got to do something productive with your money, as Kelley is, I'm sure, giving you lots of good choices.
As you might know, Joanne, and a lot of my listeners here know that I have a radio show. I have a lot of people call in, and they've got a lot in cash. It's just in cash. And to that last slide is a great point, because you're losing money safely when you've got money just in cash, because
you're guaranteed to lose money.
You're guaranteed to lose money. The inflation is eating away at that, and that's rearing its head, as we know. So yeah, I love that chart. That's a good chart.
Yeah. So interest rates, are low. 10 years up 1.62, 1.63% today, but that's still less than inflation. But that means it's cheap for households to borrow, cheap for firms to borrow. The Fed has a dual mandate, right? Their job is to maximize employment and to keep prices stable. Now, inflation's up. You might say, well, what's the Fed doing? Well, what they're recognizing is one of the big reasons inflation is up is because of the shortages. And they know that's a temporary problem. So there's still a lot of debate, though, as to, well, how long is temporary? How long is transitory? Their view is, hey, look, we can identify the shortages. We can identify where this price increase is coming from and where that price increase is coming from. We know that this is a supply bottleneck. We know a lot of this stuff is going to get solved. And so they want to avoid doing anything to discourage the economic recovery, even allowing inflation to run up like it has, because they know the source of it in a lot of cases is temporary. And so that's what they're doing. They have started to taper their bond purchases. So one of the tools they've had in their toolkit is injecting cash into the system, right? So they've been buying bonds, right? Putting money, cash money in the pockets of, people that are selling bonds and putting the bonds on their balance sheet. So they have this big balance sheet and they continue to buy stuff. They decided they're going to taper, right? So that's the beginning of less accommodation. They're injecting less liquidity now into the system, and they're going to let their, purchases run down to zero. There's no announcement here that suggests they're going to reduce the size of the balance sheet. They're just going to stop adding to it. Okay. So no big change. The Fed isn't going to suddenly dump a bunch of bonds on the market and drastically change the liquidity situation. They're just slowing down the amount they're adding. Okay, that's a good thing. And then secondly, the question is, will the Fed then increase the federal funds interest rate, which is a short-term rate, an overnight rate that banks pay? And they've made it clear they're in no hurry to do that, right? They want to maximize employment, and they want to see, how long they can just let the economy go its own way without trying to inhibit the ability of firms and households to borrow cheaply, because that's good for economic recovery. So we should expect to see interest rates start to climb just naturally, not because the Fed is going to do anything, but because we're recovering and interest rates tend to rise. Inflation is high. We should start to see that feed into interest rates. And so over time, we do expect rates to rise. And as Kelley pointed out, bond prices will fall. Got to be real careful about where you put your money on the fixed income side. So we're taking all that into account. We're also recognizing that as interest rates rise, that tends to reduce multiples on stocks, particularly high multiple growth companies. And we already saw some of that happen. In fact, in the spring, we saw a number of software companies suffer a very steep drop in valuation as two things happened. One, the Delta wave picked up and that hurt some of their businesses. And two, interest rates did pick up early in the year and people decided to move some of their holdings away from some of those higher multiple growth stocks. So we are watching that to see how interest rates are going to move and trying to take some steps to mitigate that. But one should also recognize that even when interest rates go up and reduce stock multiples, that's a one-time event. Rates go up, multiples go down, but then the stock continues to go up because earnings are growing over time. So it's important not to overreact to that risk of rising interest rates on stock valuations, because if you're in it for the long term, you care more about earnings growth than you do about a reset of valuations that's going to be a one-time event. So we have to be a little careful about overreacting to that. So we do expect interest rates to continue to rise as they have been over the last week. And we expect the Fed to raise interest rates middle of next year, late next year, something like that. Okay, as we noted, part of the shortages problem is because of low labor force participation. Really hasn't bounced back since the pandemic, but unemployment is low. In fact, it ticked down to 4.6% in October. That was recently reported. And there's still an awful lot of job openings. In fact, it's about the same for October. So lots of room for recovery to continue. Now, the political noise is, again, just hard to predict, and you can't really manage a portfolio around that. We had made already some changes in the portfolio to take advantage of the coming infrastructure bill, because we had a high confidence that that was going to happen. Various industrial companies we've owned, oil sector benefits from infrastructure investments, for example. Build Back Better is, again, more of a, and both of them are long-term bills, but if that does pass, it's more of a long-term productivity gain, just makes the US a positive environment for investing. And also potentially looking at some clean energy plays there, electric vehicle plays, et cetera. The Fed chair, people have been talking a lot about this. Will Powell be reappointed? And who knows? We don't know. We think he's done a very good job. We think it would provide probably more stability for markets if he was reappointed. But there's some chatter about potentially Lael Brainerd, who's on the board, being appointed. She's also a highly respected economist. She has certainly spoken out more in favor of stricter bank regulations. So there's some concern that if she gets appointed or even gets appointed as the bank supervisor, that could potentially hurt some of the bank stocks. But again, not necessarily a bad thing. Okay. We've already talked about China, and I think some of the issues. They were having an energy crisis, excuse me, which they seem to have gotten under control actually over the last couple of weeks. They do now seem to have secured enough sources of energy to keep their manufacturing side of the country up and running.
Are they more, did I hear that they were mostly coal?
I don't know if it's mostly, I'm not sure what the percentages are, but they're a lot coal. And one of the reasons why they had a little bit of an energy crisis over the last 2 months is they're having a spat with Australia about I think it's, partly was there were several things that caused the Australian-Chinese relationship to suffer. Most recently was when the US got together with, I think, Britain and Australia to supply cutting edge submarines to Australia. And so Australia could basically patrol in the neighborhood of China. China didn't like that. So they haven't been importing coal from Australia as much as they used to. And so they had this energy crisis, and they had to restart some of the coal mining, I guess, in China. And they basically told the utilities, get your inputs. I don't care what you pay. And the utilities had been reluctant to, because China controls the prices at which they get to sell electricity, and they hadn't raised the prices, and the cost of inputs was going up, and the utilities are like, well, forget it, we don't want to buy the extra stuff. And the government just said, too bad, you're buying it, like, go make sure there's enough energy. So they seem to have solved that problem. That was a concern for a little while. Okay, valuations. This is, I think, where folks have been most concerned, right? The market has been trading at 21 times, kind of for the last year. Even as the market stock prices have gone up, the valuation actually has been kind of flat, but it's higher than average. It's higher than historical average. We also see pretty high multiples on companies like Tesla and Amazon and, Google, not Google so much, but, some of these bigger growthier stocks. And, it's coming from earnings growth. Right? It just turns out that stock prices have risen because earnings have risen. So let me show you a few slides here. And there are plenty of valuations that are attractive. And that's why, again, we're only picking 40 to 50 stocks. We can pick and choose, right? We don't have to own the market, right? We can own just what we think is attractive relative to the earnings potential. So we're not strictly value investors. We are growth at a reasonable price investors. We're willing to pay up for a stock so long as the growth potential is there. So let's take a look. Right now the S&P, and this is maybe a week old, the S&P is trading at 21.7 times forward earnings. So the next 12 months of earnings of all the S&P 500 companies times 21.7 is equal to where the S&P is trading. But if you look at the top 10 stocks, Tesla, Microsoft, Apple, Amazon, etc., Berkshire, JP Morgan might be up there. The top 10 stocks are trading at 32.5 times. So it's a very expensive set. And remember, the S&P is a market capitalization weighted index. And so the bigger the company, the bigger the role they play in the index number. So if you take away the top 10 stocks, the remaining stocks are trading about 19.9 times. Now, that's still higher than average, which is typically 16 times. But when we look at the data and we look at periods of history when the US interest rates have been as low as they are now, that is between 1.5% and 2.5%, the market historically, since the Great Depression, has traded at 19.5 times on average. So when interest rates are this low, it's typical for the market to trade at these levels. So we're not an expensive market right now. And then when you look at those top 10 stocks, what you're also seeing is they have become a very large portion of the index. So the top 10, again, is 30% of the index. And then when you look at the earnings growth, the earnings contribution of those top 10, They're 30% of the index, but they're accounting for about 30% of the earnings. So they're not expensive even relative to their own earnings contribution. So it's a good level of support. And here's another picture I think it's really compelling. So this is earnings growth of the S&P 500 broken down by sectors. And you can ignore the gray bars. Okay, that's just looking at how things have changed in the last few months. The S&P 500 is this one third from the left. The growth of earnings of the S&P 500 companies in the third quarter that just reported came in at about 39-40% year-over-year growth. And the S&P 500 is up around 40% year-over-year. So the S&P has grown, but it's been supported by the earnings of the S&P 500. So, so we have a lot of support right now for the market to have risen 40% year-over-year. It's risen because earnings have risen 40% year-over-year. Okay, and that's been not the same across sectors. Of course, you don't get that kind of growth in consumer staples. You don't get that kind of growth in utilities. It's been materials and industrials. Energy is blank here because you can't calculate growth year-over-year when last year was negative earnings. Right. The other thing we notice when we look at the market, right, is the amount of dispersion in stocks. And just think about the width of this gray area here, right? The median S&P 500 price to earnings ratio, again, it's currently around 20 times. But the dispersion is much larger than normal. That is, you have a lot of stocks that are really cheap and a lot of stocks that are really expensive, right? So you have a lot to choose from. As an investor, right, as a portfolio manager, I can go find a lot of things. And what this also tells me is there's a lot of stuff that's up here that's way expensive. We can just avoid those if we want to, right? And always remember, there's always a lot of volatility, right, in the market. Okay, this chart is showing you the worst drawdown, right, within each of these years. So during COVID, the market fell 34%. Okay, this year, the biggest drawdown we've had so far is 5%, right? And this is where the market ended up in each of those years. So if you look at all the years in which the market had at least a 10% drop, in more than half of the years, the market ended the year up. And so if you had panicked earlier in the year when the market pulled back and say, oh, let me get out of this market, let me go back to cash, you would likely have, you certainly would have missed where we are today, which is up, the market 25%. So the lesson here is don't panic when the market pulls back. We typically have a few 5 to 10% pullbacks every year. The last, this past year has been actually remarkably stable, and that's not always the case. But as you can see, most years you get some pretty big drawdowns, but most years the market ends the year up and up double digits. So I think that's all I had, and I'd be happy to answer any questions.
Okay, let's see, there are a couple here. Let's see, are people being paid in any way besides standard unemployment benefits by either the state or federal government to stay off work?
Not anymore. Now, the extra payments have now evaporated at the federal level and at the state level, at least to my knowledge. I don't think there are any extra. There's still plenty of people earning unemployment benefits. There are still plenty of people getting disability payments, and many of those may be long haul COVID people, right? So there still is, there still are plenty of monetary incentives for some people to remain out of the workforce.
Any comment about the invasion at the border, the unvaccinated folks that are coming down there, the wages or the jobs they might take away from Americans that want to work? Any comments about any of that?
Yeah, it's always a mixture, right? The question of the border problem is a multifaceted problem, right? Number one, it's a border problem, right? We have these people that are massing on the border that want to come in that we don't have the capability to handle, right? We haven't had the capability to handle the border surge for decades, and it comes in waves, and this is a bad one. Look at, and this isn't just the US, look at Belarus and Poland at the moment. The question of unvaccinated, I think, first of all, I'm not an expert on the details of what they're doing with these people, right? We know that some of them have been sent back, right? We know that some of them that get to come in are being vaccinated as they come in. So I don't know. I haven't seen any data that suggests any link between the uptick in cases and the problem at the border. And I know folks have looked at that, and I've looked for the data. So far, that doesn't seem to be a source of cases, problems in the US. The bigger question that is being asked, though, is what about the influx of these people and taking away jobs? And it's certainly the case, right, that the immigrant workforce, at least the low skilled immigrant workforce, the illegal immigrants that come in, have certainly taken away jobs at the low end of the US workforce, right? On the other hand, we know that there has been massive shortages of labor in many areas that typically use immigrant labor, like agriculture, right, in the US. We've seen farmers struggling to get enough people to, harvest the fields. We've also seen service industries get remark that they can't get enough people to be house cleaners in hotels. The ski industry in New England, Colorado, California complained last year that they really suffered from a lack of immigrant labor because a lot of those jobs are filled from folks from abroad. So the low end service jobs certainly are places where the immigrants compete with US labor, but right now we're suffering from a shortage of labor. And the fact that legal immigration has been curtailed dramatically for 2 years because of COVID has actually contributed to the labor shortage, which is driving up wages. And so it's certainly slowing down the economic recovery. It's unclear whether any progress will be made to, to modify the immigration program to allow that labor in. And the other area where it's really biting is in construction.
Yeah.
Housing construction has really been curtailed from a lack of labor, a lack of people. If you try to get any work done in your house lately, really hard to find people. And so that often, again, that was an area of immigrant labor. And so I do wonder what the infrastructure bill will do to the demand for construction labor and how that might compete with labor to build houses. But again, it's not an urgent problem. I think we have a couple of years before projects really get rolling. So hopefully we'll be able to solve the labor shortage by then.
Well, we're almost to an hour here, so I'll probably wrap it up here in a second. Thank you for everyone for attending. Joanne, I so appreciate you being on the call with us. Your insight is always very, very valuable. I just can't thank you enough. I love Advisors Capital for many reasons, Joanne being a close friend, but I love that they look forward. They're forward thinking. They're not necessarily worried about different things that other people might be looking at. They're looking at, okay, how can we take advantage of these markets that are coming at us? I think that's brilliant. I also love that they buy 40 or so individual positions for each portfolio. It does make you guys very nimble. Let me ask you one final question here. Do you guys ever go into cash, or do you stay invested all the time? Like if the market goes down 10,000 necessarily tomorrow, would you maybe take some of the money off the table at all?
We do some things around the edges. Like sometimes if the market's doing really well, we actually might want to trim something and create a little bit of cash in case the market does that pullback. Because when the market pulls back, that's not generally the time to go to cash. It's usually trying to find the bargains, right?
Well, so the market had a 12 bull market run pretty much. So do you have more in cash today than you had before, or no?
No, because I think there's still a lot more room for the market to run.
Okay.
right? And the reason I think that is because earnings have gone up and supported that market expansion.
Mhm.
I don't think we're gonna, look, hate to try to pull out the crystal ball and say, what's the market going to do for the next 12 months? But we should all be realistic. I mean, we've had a massive recovery, 40% recovery year over year. We're not going to get that again, right? We should expect to go back to more normal growth and appreciation over time. Now we're still recovering, so I do think we run above normal for a while. But people, the market's forward looking, and the market will anticipate their earnings growth will slow down over time. And then if some other shock comes along, right, whether it's military, politics, inflation runs a little longer, higher than expected, right, or whether the immigration issue at the borders, as one of your clients raised, if that becomes a bigger issue, that could disturb the market. So there's always these risks. And again, we do try to put stuff in the portfolio to protect against that, whether it's owning defense companies, owning a pharmaceutical company, owning housing. There's a lot of ways to play defense against some of those risks.
Oh, great. Well, Joanne, thank you so much. I really appreciate it. I know we'll get you on again in another number of months to get your uptake on what's going on. But thank you so much. We so appreciate it. Thank you, everybody that attended. We appreciate your questions. Thank you, Joanne.
My pleasure. Have a happy Thanksgiving, everybody.
Absolutely. You too.
Okay. Cheers. Take care.